All right, so the confusion remains in the housing market. It is causing a bifurcated market, which is sidelining many would-be buyers and sellers. And it's honestly one of the most interesting markets that I've probably ever witnessed. And the data here, I think you're gonna find it very surprising. We're gonna go over Redfin's weekly housing market update, look at all of the stats and facts here in the real estate market, and we're going to talk about where mortgage rates are and where they may be headed here in the future. All right, so we have the median sales price year over year is actually up 3.2%. And you can see where we were just a few short years ago in 2020. We had the median home price sitting under 300,000. As of today, we're sitting at just over 380,000. Now, this is actually off peak levels that we saw in June of 2022. However, it is up year over year. Now we have the median asking price is up 1.7% year over year, coming in at 387,000. This is actually higher than the median sales price. But what I want you to keep in mind is this is the median asking price. So in other words, it's right in the middle. So you have some homes that are going to be at the higher end, some that are going to be lower, but this is where it sits right in the middle. In addition to that, we have seen mortgage rates come up. In fact, homebuyer housing payments are up about 19% year on year. That's bringing the average to just over $2,600 per month, which is putting a further squeeze on affordability. This is sitting at a rate of 6.9%, but just as of last week, we actually topped 7% according to Mortgage News Daily. So you can see here, this is the conventional 30-year fixed rate mortgage, just north of 7%. And then you have the government products here. So FHA and VA loans are sitting at about 0.5% less, coming in at about 6.68%. Mortgage rates still remain relatively volatile. And a lot of this has to do with the 10-year treasury yield, which is what mortgage rates follow very closely. Now on this chart, and this is what I really wanted to point out to everyone here, is that you have the 10-year treasury yield right here in blue. And then you have the 30-year fixed rate mortgage. It's the average in the United States here in red. And what I want you to pay attention to here is the spread between the 10-year treasury yield and the 30-year fixed rate mortgage. You can see that these generally follow in lockstep fashion. So when the 10-year yield goes up, mortgage rates go up with it. When the yield goes down, mortgage rates go down with it. Well, as of right now, we're actually sitting with a 10-year treasury yield at right at about 4%, with the 30-year fixed sitting right at about 7%. So you have about a 3% spread. Now, on average, generally the spread between the two, historically speaking, is maybe a little bit less than 2%. And what this is an indication of is that there is more and more risk in the market. So the spread on these tends to widen. So my thought here is that when we move into the winter and spring of next year, if the volatility starts to settle down, we'll actually see the spread between these two compress a little bit, and maybe the 30-year fixed rate will actually improve, bringing affordability to a slightly more manageable level than where we are today. Now, lots of people are actually talking about housing prices crashing. And based on the data that we are seeing here today, we actually have seen home prices stay relatively stable. And a lot of that, I would imagine, has to do with the lack of inventory that we're seeing in the market. One thing that we have seen, however, is a pretty significant crash in transactions. We can see pending sales are actually down 14% year on year. This is the lowest that we've seen in a 3-year period. And then if we take a look at the active listings that are for sale, we're actually down 19% year on year, also the lowest level that we've seen in 3 years. Now, what you typically see this time of year is a nice upward trajectory that goes into the summer months, rounding off in about August or September, just like we saw in 2022. You can see this red line here. We saw that the active listings actually peaked sometime in August going into September before it started to taper off into the winter months. Well, what happened this year is that we just did not see that inventory come into the market. Instead, what we saw more or less is what we would call a lock-in effect. So a lot of these would-be sellers that maybe were on the fence and they were thinking about selling, well, mortgage rates have gone up so much. So instead of trading their 3% mortgage rate for a 7% mortgage rate, they decided, hey, I'm not going to sell this property. And basically, it is not very compelling for them to sell because they know they'd be trading such a low mortgage payment for a significantly higher one. And as a result, the move-up buyer has pretty much stepped back from the market altogether. And so what's happening is we're starting to see more first-time home buyers enter this market so long as they can afford it, which is unfortunately very, very tough right now. And of course, there's a variety of other reasons why somebody may list. There's life circumstances or life events like marriage and divorce or a growing family and things like that. But as of this moment, we are seeing significantly less inventory. We're seeing less pended and less closed sales. Here's where I think there is a twist in the data, which makes this really fascinating. In fact, one of the most probably interesting housing markets that I've actually ever encountered. But when you look at this, it says 44% of pended sales are actually under contract within 2 weeks. So the average days on market is still relatively low if we're looking on a national level. It's a good indication that if the property is squeaky clean, it's priced correct, there is still buyer demand and they're moving relatively quickly on these properties. What's even more intriguing is that 36% of homes actually sold above the final list price. This is still an indication that we are in a very strong seller's market at this time. And I think a lot of that has to do with the lack of inventory that we're seeing. It's absolutely contributing, at minimum, to keeping prices up and getting these properties to move relatively quickly. Of all the active listings, 5.8% actually saw price reductions. This is starting to reach levels that we saw in 2022. It could have a lot to do with mortgage rates recently rising to just over 7%. You can see here in 2022, this red line saw a massive spike as interest rates move up. And you can see that where we are as of right now, we are starting to see more price reductions unfold. We're just going to have to continue to monitor that and see how that plays out here over the coming months as we roll into the winter. This is what I thought was really interesting. So remember how we said 36% of homes are selling above the final list price? On average, homes are selling for 100% of what they're listed for. In other words, if you have a home listed for $400,000, on average, it's selling for $400,000. And this is where I think there's some bifurcation in the market, because you have some of these properties that maybe they show very well, they're in an excellent location, they price them correctly, and those are the homes where there's a tremendous amount of buyer demand. Maybe they're driving the price up slightly, and they're selling very quickly, like inside of 2 weeks. And then on the flip side of that, you have homes that are sitting on the market longer. They need a little bit of work. Maybe they're not in an ideal location. And those are selling for less than list price. And it's bringing that average to 100%. So a little bit of anecdotal evidence, what I'm still seeing in the market here locally in the Northern California, Sacramento market is exactly that. And some of the homes that are priced really well, they move quickly. Maybe something about them makes them really special, like they're in a fantastic area, they have a really nice backyard, or something like that, where the buyer that has been waiting in the wings for 6 months, they've been actively shopping, the right property comes up and they pounce. Whereas we have some that need a little bit of work, maybe they're in a less than ideal location, they sit on the market longer, and when they do sell, they are selling generally below list price, and a lot of times there are concessions attached to those properties as well. So you start to see like seller credits for closing costs or rate buy downs and things like that. All right, so that is gonna wrap it up for the data. I hope you all are doing well. It's been a while since I've actually made a video. I'm gonna try to get back into it on a more regular basis. Being honest, it's very tough to do this consistently when we're juggling multiple things and a job and family and things like that. But I'll do the best I can to keep you guys informed on what's going on in the housing market. If you're new to this channel, please hit that like button and subscribe. We'll see you next time. Take care.